Many investors find reassurance in the notion that success in the financial markets doesn't require extraordinary skill or constant brilliance. Instead, the key is simply to avoid making significant mistakes. This comforting idea has gained widespread popularity, shaping the core of many investment philosophies. By focusing on risk management and steering clear of major errors, investors believe they can safeguard their portfolios and achieve steady, long-term growth. The appeal lies in its simplicity, offering a practical approach that feels accessible to both seasoned professionals and newcomers alike. As a result, this mindset has become a guiding principle for countless individuals seeking to navigate the complexities of investing. While the quote may appear insightful at first glance, it's important to question its validity and consider the potential risks it poses. Investors who accept such statements without scrutiny could find themselves guided by misleading assumptions. This approach may oversimplify complex market realities, leading to decisions based on incomplete information. In some cases, quotes like these can act as intellectual traps, encouraging overconfidence or complacency. By critically examining the underlying logic, investors can avoid falling into patterns that may ultimately undermine their financial goals. Recognizing the limitations of popular wisdom is essential for making informed, strategic choices. This concept acts as a crucial distinction between those who achieve lasting, multi-generational wealth and those who remain stagnant. Individuals and families who embrace proactive financial strategies often lay the foundation for enduring prosperity, passing on resources and opportunities to future generations. In contrast, complacency can lead to missed opportunities, limited growth, and vulnerability to economic shifts. The dividing line is marked by a willingness to adapt, learn, and invest with foresight. Those who recognize and act on this idea are better positioned to overcome challenges and secure long-term financial stability. Ultimately, the difference lies in the commitment to continuous improvement versus settling into comfort and routine. Before we can begin to dismantle the trap of avoiding big mistakes, it's crucial to first understand what this concept truly entails. The phrase, avoiding big mistakes, often evokes a sense of caution and careful decision-making, but its meaning can vary widely depending on context. Are we talking about financial errors, personal misjudgments, or professional setbacks? By clarifying what constitutes a big mistake, we set the stage for a more focused and meaningful investigation. This foundational understanding allows us to identify the underlying fears and assumptions that drive our behaviors. Only then can we effectively challenge and rethink the patterns that keep us stuck. As we explore the concept of avoiding big mistakes, it's important to recognize that each person's definition may be unique. What does avoiding big mistakes mean to you in your personal or professional life? Take a moment to reflect on the experiences or decisions that have shaped your understanding of this idea. By sharing your thoughts and perspectives, you contribute to a broader conversation that helps others learn and grow. Feel free to engage with the discussion and let us know your views in the comments below. Many investors encounter the quote and interpret it in a passive manner, believing it suggests that simply holding investments over time is the key to success. This perspective encourages a hands-off approach where frequent trading or attempts to time the market are avoided. As a result, investors may feel reassured that patience alone will yield favorable outcomes, regardless of market fluctuations. This passive interpretation can lead to a reliance on long-term strategies, such as buy and hold, with minimal portfolio adjustments. While this approach can help reduce emotional decision-making and transaction costs, it may also cause investors to overlook important changes in market conditions or individual asset performance. Ultimately, the widespread passive reading of the quote shapes investment behavior by promoting stability and discouraging reactive moves. but it may not be suitable for every financial situation. Passivity is often celebrated as a form of wisdom, with restraint and inaction praised as signs of good judgment. This perspective tends to emphasize the dangers of mistakes made by taking action, known as mistakes of commission. As a result, individuals and organizations may become overly cautious, fearing the consequences of doing something wrong. However, this mindset frequently overlooks mistakes of omission, the errors that arise from failing to act when action is needed. By prioritizing the avoidance of visible missteps, opportunities for improvement or innovation can be missed. The subtle costs of inaction, though less apparent, can be just as significant as the risks associated with taking decisive steps. Recognizing both types of mistakes is essential for balanced decision-making. The gospel of passivity in investing promotes the idea that minimal involvement and a hands-off approach are always best. While this philosophy can reduce stress and transaction costs, it often leads to complacency, where investors neglect to review or adjust their portfolios in response to changing market conditions. Over time, this passivity can foster ignorance, as individuals may stop educating themselves about new opportunities or risks. As a result, they develop a false sense of security, believing that simply staying the course will guarantee success. This mindset can leave investors vulnerable to unforeseen downturns or missed chances for growth. Recognizing these pitfalls is crucial for maintaining a balanced and informed investment strategy. Passive ignorance can be one of the most significant threats to investors. When individuals fail to seek out information or neglect to question their assumptions, they expose themselves to mistakes that can be both costly and irreversible. Often, the most damaging errors are not those of commission, but rather mistakes of omission, opportunities missed, risks unrecognized, and warning signs ignored. These oversights can quietly erode portfolios over time, sometimes without immediate notice. The prevalence of such errors among investors underscores the importance of vigilance and continuous learning. By remaining actively engaged and informed, investors can better protect themselves from the hidden dangers that passive ignorance presents. Warren Buffett and Charlie Munger have long emphasized the importance of avoiding big mistakes as a cornerstone of their investment philosophy. Rather than simply steering clear of minor errors, their approach involves a deeper, more active process of identifying and sidestepping major risks that could jeopardize long-term success. This means thoroughly understanding potential pitfalls, exercising patience, and maintaining discipline even when opportunities seem tempting. By focusing on what not to do, they create a strong foundation for consistent growth. Their definition of avoiding big mistakes is not passive. It requires vigilance, careful analysis, and the courage to walk away from questionable ventures. This mindset has been instrumental in shaping their remarkable track record over the decades. Understanding your circle of competence is crucial for making sound decisions and achieving long-term success. This concept refers to the areas where your knowledge and skills are strongest, allowing you to operate with confidence and accuracy. By clearly defining your circle of competence, you can focus your efforts where you are most effective and avoid unnecessary risks. Equally important is the active process of recognizing the limits of your expertise. Acknowledging what you don't know helps prevent overconfidence and costly mistakes. Regularly assessing and updating your boundaries ensures that you remain grounded and make informed choices. Ultimately, knowing both your strengths and your limitations is a key factor in personal and professional growth. Accurately valuing a business requires more than just surface-level assessment. It demands intense analytical rigor. By thoroughly examining financial statements, market trends, and operational metrics, investors can gain a clear understanding of a company's true worth. This careful scrutiny helps to identify hidden risks and potential opportunities that might otherwise be overlooked. Without such diligence, there is a significant risk of overpaying, which can lead to poor investment outcomes. Ultimately, disciplined analysis serves as a safeguard, ensuring that decisions are based on solid evidence rather than assumptions or incomplete information. Passive inaction occurs when we avoid taking action simply out of habit, fear, or uncertainty, often without considering the consequences. In contrast, earned inaction is a deliberate choice made after careful evaluation and preparation. It reflects a disciplined approach where knowledge and readiness inform when it is best not to act. True discipline is not just about doing more, but about knowing when to pause, reflect, and wait for the right moment. This kind of restraint is built on a foundation of understanding and preparedness, ensuring that every decision, including inaction, serves a meaningful purpose. Throughout history, the passive myth has often painted a picture of events unfolding without intention or agency. In contrast, the active reality reveals a landscape shaped by deliberate choices and meaningful actions. By examining both perspectives, we uncover the gaps where misunderstanding can take root. Recognizing these differences allows us to close the loops of confusion and gain deeper insight into the true nature of events. Ultimately, bridging the divide between myth and reality enriches our understanding and helps us move forward with greater clarity. One of the most common pitfalls in decision-making is mistaking ignorance for prudence. Often, people believe that by choosing not to act, they are exercising caution. However, inaction can be just as risky as making a poorly informed choice. When we rely on doing nothing as a strategy, we may miss critical opportunities or allow problems to escalate. True prudence involves seeking knowledge, weighing options, and making deliberate choices. Confusing hesitation with wisdom can lead to stagnation and unintended consequences. Recognizing this trap is essential for making thoughtful and effective decisions. Ignorance is often mistaken for a margin of safety in investing, but this misconception can be costly. Simply not knowing the risks involved does not protect you from them. In fact, it can expose you to greater losses. Passive investing, while popular for its simplicity and low fees, may also carry hidden dangers. Over time, blindly following market indices without understanding underlying fundamentals can result in missed opportunities and gradual erosion of wealth. Market conditions change, and companies within an index can underperform or decline. Without active oversight and informed decision-making, investors risk falling behind inflation and failing to achieve their financial goals. True safety comes from knowledge, vigilance, and a proactive approach to managing investments. The most significant mistake investors can make isn't simply experiencing dramatic losses. Instead, it's neglecting to learn about, analyze, and truly understand their investments. Without a solid grasp of what you're investing in, decisions become guided by guesswork rather than informed judgment. This lack of understanding can lead to missed opportunities, unnecessary risks, and poor long-term outcomes. By prioritizing education and thoughtful analysis, investors can make choices that are better aligned with their goals and risk tolerance. Ultimately, knowledge is the foundation for successful investing. At the heart of this channel lies a commitment to safety, peace of mind, and genuine ease. These principles guide every topic we explore, ensuring that viewers feel secure and informed. However, it's important to recognize the difference between real ease and its imitation. Fake ease often comes from shortcuts or ignoring potential risks, offering a temporary sense of comfort that can quickly unravel. In contrast, true ease is built on thoughtful preparation, reliable information, and responsible choices. By distinguishing between these two, we empower ourselves to make decisions that foster lasting peace of mind and authentic security. This approach not only aligns with our philosophy, but also helps create a more resilient and confident community. True safety and peace of mind in investing are not products of chance or wishful thinking. Instead, they are achieved through a foundation of knowledge, disciplined decision-making, and thorough preparation. Investors who take the time to understand the markets, research their options, and set clear strategies are better equipped to navigate uncertainty. Discipline helps maintain focus and avoid impulsive reactions to market fluctuations. Preparation ensures that risks are managed and goals remain in sight, even during turbulent times. Ultimately, lasting confidence in investing comes from these deliberate actions, not from relying on luck or hope. Developing strong habits is one of the most effective ways to steer clear of major mistakes. By consistently practicing good routines, you create a safety net that helps guide your decisions, even when challenges arise. Everyone has their own strategies for staying on track, and sharing these approaches can benefit others in the community. If you have techniques that help you avoid pitfalls, consider sharing them in the comments. Your insights might inspire someone else to strengthen their habits and make better choices. As we wrap up this segment, we invite you to share your favorite investing quotes or suggest topics you'd like us to explore in greater depth. The world of investing is rich with wisdom, and each quote offers a unique perspective worth examining. By remaining curious and open to new ideas, we continue to grow as investors and thinkers. Ongoing learning is essential as it helps us adapt to changing markets and refine our strategies. Your input helps shape future discussions, ensuring they remain relevant and engaging. Together, we can uncover valuable insights and foster a deeper understanding of investing principles. As we wrap up our investigation, it's clear that staying curious is essential in navigating the world of investments. We've explored the importance of thorough research, recognizing warning signs, and understanding the risks involved. Remember, informed decisions can help protect your financial future. Always verify sources, seek expert advice when needed, and never rush into opportunities that seem too good to be true. By applying these key takeaways, you can invest with greater confidence and security. Stay vigilant, keep learning, and invest wisely.